right, now keep your eyes on the chart and don't rush. Up to this point, the market looks strong. Price has been moving upwards smoothly. Each pullback has been shallow. Buyers are stepping in quickly, and momentum feels clearly bullish. This is the kind of environment where most traders feel comfortable buying pullbacks without thinking twice. Now slow down right here. Look at this candle forming near the top of the trend. At first glance, it doesn't look dangerous. The body is small, sitting near the top of the range. Some traders even ignore it because it doesn't look aggressive. But this is exactly where most people make a mistake. This candle is known as the hanging man. But forget the name for a second. Let's understand what actually happened during this candle. During this single candle, price dropped sharply. Sellers came into the market with force and pushed price much lower. That long lower wick you see is not random. It represents strong selling pressure that appeared for the first time after a long bullish move. Now, buyers did manage to push price back up before the candle closed. That's why the body is near the top. And this is why beginners think this candle is bullish or harmless. But professional traders don't just look at where the candle closed. They focus on what happened inside the candle. And what happened here is simple but important. Sellers were strong enough to shake the market. Now zoom out and look at the context. This candle appears after an uptrend, not in the middle of a downtrend, not in a random sideways market. That context changes everything. In a strong uptrend, buyers should stay in control the entire time. Price should not fall deeply during a single candle. But here it did. This is the first sign that buyers may be losing strength. Think of it like this. The trend didn't break yet, but it stumbled. Now here's something very important you must remember. The hanging man is not a sell signal by itself. If you sell immediately after seeing this candle, you're gambling. This candle is a warning, not an entry. So what do smart traders do next? They wait. They wait for the next candle to speak. If the next candle closes bearish, or if price breaks below the low of the hanging man, that's confirmation. That's the market saying, yes, sellers are stepping in now. Only after that confirmation does this pattern become tradable. Now let's talk practically, directly on the chart. Your sell entry should always be below the low of the hanging man, not at the close of the candle. Your stop loss goes just above the high of the hanging man. Why? Because if price breaks that high, the idea is wrong, and you exit without emotion. Your first target should be a nearby support area. Your second target can be the previous demand zone or a key moving average. Now here's a detail most people overlook. The hanging man works best when it forms at major resistance levels, previous highs, or psychological round numbers. If this candle forms in the middle of nowhere, its power is reduced. And if you add confirmation from indicators like RSI showing overbought conditions or bearish divergence, this pattern becomes even stronger. One more thing. The hanging man does not mean the market will crash instantly. It means the uptrend is under pressure. Sometimes price consolidates before dropping. Sometimes it pulls back and then continues. Your job as a trader is not to predict. Your job is to wait for confirmation and manage risk. This single candle teaches patience. It reminds you that trends don't end suddenly. They weaken first. So the next time you see a small-bodied candle with a long lower wick forming at the top of an uptrend, don't ignore it. Pause. Read the story inside the candle. Wait for confirmation. That's how professionals trade candlestick patterns. Calmly, logically, and without emotion.